Okay, let's get started. So we started off with a list of the standards that we have to cover. So I think from the list so far, we've covered accounting for inventory. We did cover accounting for inventory. We did also look at IAS 16, accounting for property, plant, and equipment. So we said we want to start with standards that normally deal with PPE, that are related to PPE and assets. We want to start with standards that are related to assets. So we did look at IAS 2, inventory being an asset. We did look at IAS 16, PPE. We did also look at accounting for government grants, where we are given money from the government. It could be to cover for a capital expenditure, or it could be a revenue grant. So we did look at that. And we also did look at IAS 23, how we account for the borrowing costs. So we did look at how we account for the borrowing costs. Then in the last session, we're now looking at impairment of assets. So let's quickly rush to the last thing we were talking about. So we're going to quickly recap IAS 36, then maybe we look at one or two questions, then move to the next standard. So we want to try to move and cover as much ground as possible. So covered, that's IAS 36. So IAS 36, this looks at impairment of assets. So when an asset is impaired, we say that the carrying amount is higher than the recoverable amount. So we are saying the amount we have recorded for this non-current asset is higher than what we can recoup, or than what we can recover from the non-current asset. So if we are saying that there is an impairment loss, the assets, in other words, are over-recorded. The carrying amount of the assets is higher than what we are capable of receiving from that asset. So maybe we forgot to put the indicators of impairment. Let's add those. Let's add those, then we come back to, before I forget. So yes, we need the indicators of impairment. So what can give rise for the organization to carry out an impairment review? Do we just decide anytime we need to conduct an impairment review? No, there are some conditions we need to take into account. If these conditions are there, if these conditions are present, then we are supposed to conduct an impairment review to check whether the assets are not overvalued. Because if these conditions are present and you do not carry out an impairment review, there's a risk that you're going to overvalue your PPE. So the first condition is decline in the market value. So there can be a decline in the market value of the asset. So we can have decline in market value. So an asset could be impaired because the value of the asset in the market has dropped. So decline in market value can be because of factors such as maybe new technology has been brought in the market, or the use of that asset is no longer the same. Let's think of a case, maybe you have bought a machine to produce masks for COVID. Then all of a sudden there's a cure for COVID. It means there's going to be a decline in the market value for that machine because it's no longer in demand. Its purpose that it was serving is no longer feasible, or it's no longer that in demand. Of course, we can continue to produce the mask, but the demand for the masks is going to reduce. So it means the value, the market value for that machine is going to drop. Then from there, we move on to, so besides the decline in market value, we can have changes in technology. So once that machine there are now new versions for that particular machine. It might mean what you were expecting to get from the machine is no longer what you will get because of new technology, maybe your customers will start preferring products made by the new advanced technology as compared to that machine you bought. So if you expected that it has a useful life of 10 years, but now there is a new machine in the industry which is performing much better than that particular one, it might result in its life even reducing because we are not going to use it for that long. So the changes in technology, they can also give rise to the need to carry out an impairment review. So if we are carrying out an impairment review, we are suspicious that the carrying amount could be higher than what we can recover from the asset. So these are conditions that can show you, no, your carrying amount might be higher than what you can recover from the asset. Then also decline in the share price. Decline in the share price of the company. That can be an indicator as well that you're overvaluing your assets. Your share prices are falling, but you are still maintaining the assets at very high price. So when there's a decline in the share price of the company, it might indicate poor performance of the company. It might indicate that your assets are not performing as intended. So that might also show that you have overvalued your PPE. So that's again an indicator of impairment. Then also we have physical damages to the asset. Physical damage to the asset. So these are damages we can actually see on the asset. So physical damage to the asset. So if the asset is physically damaged, we have to conduct an impairment review so that we consider whether the carrying amount, we can still recover the carrying amount. Is it still possible for us to recover the carrying amount? Because remember, the carrying amount is what you are expecting from that asset, either from selling it or if you continue to use it in the business. So if there are physical damages to the asset, this might entail that we will fail to recover. We will fail to recover what we wanted from the asset. So the physical damage to the asset can also be an indicator of impairment. Then besides the physical damage to the asset, we can also look at the changes in the way the asset is being used. So if there is a change in the way the asset is being used, change in the way the asset is being used. What do I mean by this? So we used this vehicle for ferrying passengers to and from, and we were using it as a taxi, but now we're using it as a private vehicle. So that change in use might mean the benefit you initially expected from the vehicle as a taxi is not the same benefit you are likely to get when you're now using it as maybe a private vehicle. So the change in use might have an impact in the value of the asset. It might have an impact in the carrying amount. So if there is a change in the use of the asset, we need to carry out the impairment review. So just confirm, are we together? Can you still see my screen and can you still hear me?
Yes.
Okay. So let's continue. So after there's an indicator for impairment, the next thing is we must carry out an impairment review. So if you're checking or conducting an impairment review, it's just a verification that indeed the assets, they still have the carrying amount we have recorded in the books. We have not overvalued the assets that, we have not overvalued our assets. We have not overvalued our assets. So we did mention, now let's go back and quickly have a recap of what we did talk about. So after there is an indicator for impairment, what is the next thing? After there is an indicator for impairment, we need to, first of all, identify what is the market value. So currently in the market, how much is this asset going for? So we need what you call the fair value. So the fair value, this is what those in the market are willing to pay you for this asset. So currently, if we are to find the highest bidder in the market, how much are they willing to pay us to get this asset? So we gave an example last time that if we have this asset in the business and the highest bidder is saying, I can pay you 38,000, but to get this person, we need to pay, we need to find an agent who can help us. So the agent needs their agent fee of 2.5. So it means that what we can recover from the market, what we can recoup from the market is 35.5. So that is the maximum we can benefit from this vehicle. So the fair value is the maximum we can get from the market. This is what those in the market are willing to pay in order for them to receive that asset in an orderly transaction. That is, provided that they have not been forced, provided they're doing it at arm's length, they are not someone whom you know. So provided it's a transaction at arm's length, how much are they willing to pay for that particular asset? So we then realize, okay, they are willing to pay 35.5 for the asset. They are willing to pay 35.5 for the asset. But in our books, we have recorded this asset at what carrying amount? So in our books, the carrying amount for the asset is 40,000. But if we go into the market right now, the maximum that someone is willing to pay us is 35.5. But you can argue and say, it's not only the option available for me to sell the asset. I can still benefit with 40,000 even without selling the asset, but if I keep using it in the business. So the value in use, it is the benefit we are going to derive, provided we have continued using this asset in the business. We have decided not to dispose of the asset. So we then calculate the projected cash flows, the projected benefits you are likely to get if you are to continue using the asset in the business. But these are projections. So the value in use is a projection. We are estimating that if we are to keep using this asset in year one, how much are we expecting to receive? Up to the last year, we're expecting to be using the asset. So these projections, please be sure to discount them to present value. So we did come up with these projections, and the value in use calculated was 27.2. So it means we are saying if we continue using this asset, the maximum we can get is 27,200. That's the value in use, the maximum we can recoup, provided we have not disposed of the asset, we have decided to keep using it in the business. Then, so it means if we sell it right now, we can get 35.5. If we continue using it, we can get 27.2. But in our books, we have recorded 40,000. So it means the asset is overvalued. But overvalued by how much? We compare these two, and we take the higher of the two. The higher of the two is what you call the recoverable amount. So for us to say this asset is overvalued by how much or is impaired by how much, we need to know, we take the higher of the fair value and the value in use. The higher of these two amounts, last time we did mention, that is the recoverable amount. After we have obtained our recoverable amount, we then say the carrying amount less the recoverable amount. So the carrying amount less the recoverable amount, that will give us the impairment loss. So we did that calculation in the last session. Then the key steps. So the key steps, step number one, you need to know the carrying amount at the date when the impairment review is being the date when you are conducting the impairment review. We also need to be able to determine the fair value. Do we have the fair value? We'll look at IFRS stating factors we might consider when determining the fair value. So we need the fair value, that is the value we are likely to get in the market after we have deducted the selling cost. Then also we need to determine the value in use. That is the value we are expecting to get, provided we've decided to keep using this asset for its entire useful life. Then after that, we need to calculate the recoverable. So we need to determine the recoverable amount, which is the higher of the fair value and the value in use. So you compare the fair value and the value in use, the higher of the two is the recoverable amount. Then after that, you then compare the recoverable amount with the carrying amount. That will give you an impairment loss. That is how you work out the impairment loss. Then we also did move on and talk about the impairment loss of a cash generating unit. So where we have more than one asset. So if it's a cash generating unit, it's a group of assets. So we did mention that a cash generating unit, this is impairment of a group of assets. So if it's a cash generating unit that is being impaired, if it's a cash generating unit that is being impaired, we said we have a number of steps that we must follow. The first step is we allocate the impairment loss to the assets which we have been deemed to be worthless. So they can tell you certain assets are now worthless. They don't have an economic value. So those ones are the ones where we firstly allocate impairment. Then we allocate impairment to goodwill. Goodwill must be written off. If there is an impairment review of a CGU, we write off goodwill or allocate impairment to goodwill. Then after that, you need to share the remaining impairment loss to the rest of the non-current assets. Remember, current assets are not impaired. So if they are current assets, we said these are not to be given a share of impairment loss. So we did look at this, and I can't maybe spend time on that again. So maybe what you need to do today is just to look at one question, and just one question. Then we move to the next. So let's just look for one question on allocation of impairment to a cash generating unit. So after that question, then we move on to the next standard for the day. I want us to look at IFRS 5 or IAS36. I'll see which standard we can start with from those two. For now, let's look at the question. Let me open the exam kit. Let's look at this one. Question 280. On 1 July 20x7, it is discovered that the damage to the to the machine is worse than originally thought. The machine is now considered to be worthless, and the recoverable amount of the factory as a cash generating unit is 950. I'm just considering, is this question starting here or what? All right, let's continue. So on 1 July 2007, it is discovered that the damage to the machine, so remember we said physical damages, they are indicators for impairment. So there is the physical damage to the machine is said to be, the machine is now worthless. And we are told that the cash generating unit as a whole now is going to give us 950,000. At 1 July 2007, the cash generating unit comprises of the following. So we have what? Buildings, but then in accordance with IAS38, what will be the carrying amount of the plant and equipment when an impairment loss has been allocated to the CGU? So let's allocate the impairment to the CGU. If you're not using the same device, can you take a peek for this question so that at least we won't need to come back? Let me do likewise so that when I open the Excel, okay, so now let's go to our Excel and work out the question. So this is from the kit. It was question 280. So we want to allocate the impairment to the CGU. So the first thing, if you're allocating the impairment to the cash generating unit, let's have the assets that we had in that cash generating unit. We had the buildings. We are told we had buildings. We want the carrying amounts of these assets. So we can put the carrying amounts here. Let me just drag the page. So we can put the carrying amount, then the share of the impairment loss here, then the recoverable amount here. So the buildings, then besides the buildings, we had the plant and equipment. So we have the plant and equipment. Then besides the plant and equipment, we have goodwill. Besides the goodwill, we have the net current assets. Net current assets. We have the net current assets. So we start with the carrying amounts that we are given. So the question it provided us with the carrying amounts. For the building, it was given as 500,000. For the plant, it was given as 335, but there is a note on plant. Then on goodwill is 85,000. The net current assets is 250,000. Okay, so the note on plant, let's go to that note. So plant and equipment, including the damaged machine at carrying amount of 35,000. So the damaged machine it had a carrying amount of 35,000. So there's now a machine which is now worthless, which had a carrying amount of 35,000. So now let's allocate the impairment to the CGU. For the sake of time, I'll do it myself first. So it means for this 35.5, it's inclusive of, it's actually inclusive of the plant that is now worthless. So we can add up the total there, we get the total carrying amount. So we are given the recoverable amount. So the question was saying that the recoverable amount is, let's go and check how much is our recoverable amount. So we are told that we can recover 950,000. So we then take our recoverable amount and put it here. So our recoverable amount is 950,000. So okay, so we are told that our recoverable amount is 950,000. So our recoverable amount is 950,000. Then after we have put our recoverable amount, we then work out our impairment loss here in total. So if overall the CGU has a carrying amount of 1,170,000, but we can only recover 950,000. So we first of all calculate how much is the impairment loss in total. So our impairment loss in total will be 220,000. Then we need to allocate this impairment loss over this CGU. So we need to allocate the impairment loss. So for the non-current assets, they are not impaired. So you don't allocate impairment to the non-current assets. So it means they still have a recoverable amount equal to their carrying amount. Then we then move on. Here, there is an asset which we know, which is now worthless. So we allocate the impairment loss to that asset, which is worthless. But maybe let's split the plant. To make it easy, let's split the carrying amount of the plant into two. So we have the plant, can say this one other, then this one the damaged. So the damaged was said to be of 35,000. So it was inclusive in this amount. So let's remove 35,000 there. So it means we allocate the impairment to the damaged asset. So we're going to allocate the impairment to the damaged asset. Then after that, we write off goodwill, or we allocate impairment fully to goodwill. So it means goodwill, again, we're going to write it off. So it was 85,000. So for goodwill, 85,000. So then the remaining impairment, you allocate it to the assets that are remaining, the non-current assets that are remaining basing on their book values. So we are saying the impairment was 220,000 minus, we removed impairment of 35,000. There was an impairment of 85,000. So we deduct these impairments. We deduct these impairments. So there's an impairment for 22,000, 35,000 and 85,000. So it means the remaining impairment after deducting, the remaining impairment then is, let's work it out here. So those 220,000, we deduct the 35,000, we deduct the 85,000. So it means that's 10,000. That's 100,000. So that's 100,000. So the 100,000 is then going to be shared among the buildings and other plant. So the buildings and the other plant is 50 plus 300. It's 500,000 plus 300,000, which is 800,000. So for building, you'd say 500,000 over the total, which is 800,000 times 100,000. So we are sharing the remaining impairment in the ratio 5:3. We are sharing in the ratio 500:300. You can just say 5:3. So here it will be 3 over total ratio 8. So 3 over total ratio 8 times 100,000. So then we get our recoverable amount. So that's 500,000 So this is now worthless, 0. This is now again worthless, 0. So these are our new recoverable amounts. Any questions? Are we together? Okay, let's move. The team joining, confirm. Are we together? I can't hear your responses. Please respond.
Yes, we are.
Okay. Okay, let's proceed. Oh, sorry about that. Okay, let's move. So from there, let's move to the next standard. I think this one, you can now do more questions on that standard. Now let's move to the next standard. So from IAS36, the standard on assets, I think let's move on to another standard, which is a recap. For those who did, they might have done this. I think F3, you did this one. So let's just quickly go through this standard. It shouldn't take us time because it's a standard that you already know. So the good part about F7 is that if you understood F3 well, it means it's just going to be a repetition of quite a lot of things that you have already done. So now let's look at IAS 38. So we did look at IAS 30, IAS 16, remember, which was on PPE or tangible non-current assets. IAS 38, on the other hand, looks at accounting for intangible non-current assets. So these ones are assets without a physical substance. So if we are accounting for intangible non-current assets. Sorry, let me just see how I can remove this on the screen. Or let's just proceed. So IAS38 looks at how we account for intangible non-current assets. So firstly, what is an intangible non-current asset? An intangible non-current asset An intangible non-current asset is an identifiable non-monetary asset without a physical substance. An identifiable non-monetary asset without a physical substance. So if you're saying there's an intangible non-current asset, number one, it must be identifiable. We should be able to separately identify the non-current asset. And it must not have a physical substance. It mustn't be, it's not an asset we can physically touch. So let's have examples of these assets. Which are these assets? Can you help me out? Which are the intangible non-current assets that you know of? You did this in your earlier studies, I assume. What examples of intangible assets? Hello, can I have the answers, please? Examples of intangible assets.
Goodwill.
Goodwill. But we'll talk about the goodwill there. There are issues regarding the goodwill, but we have goodwill, we have patents, we have brand names, we have licenses. So these are some examples of intangible non-current assets. These are some examples of intangible non-current assets. Now, let's move on. For us to regard the asset as an intangible non-current asset, what conditions must be there? So we can say conditions for an intangible non-current asset. Conditions for an intangible non-current asset should be recognized. So what is it that we should look at for us to say, let's recognize this intangible non-current asset? So what conditions must be present for us to recognize the intangible non-current asset? So the first condition is that it must be separately identifiable. It must be separately identifiable. Can we sell it without selling the business? Is it something that is capable of being sold without selling the business itself? So we can sell the name through franchising. We can sell the name without selling the business as a whole. We can sell the patent right. We can sell someone the right to use our formula, the right to use our methods. We can sell someone the license to produce maybe our product. So if it is capable of being sold to someone else without selling the business as a whole, that is the condition number one. Then besides that condition, we also have, it must meet the definition of an asset. Remember that definition of an asset from your F3, from your financial accounting. So an asset is a resource that's an economic resource we have, which is capable of bringing economic benefits. So if it's an asset, we must be in control of it, and it must be capable of bringing economic benefits. So we can say it's an intangible asset if we have been given control and it's capable of bringing us benefits. It's not every name that qualifies to be an asset. So if I buy your name and it's not going to bring any single customer to my business, so that can't qualify to be regarded as an asset because there aren't any economic benefits I'm deriving from the use of that name. So for it to be an asset, let it be a name that if I use that name, let it draw customers to my business. Let me see a change from the day I start using your brand. Let me see the change from the day I start using your method. Let me see the change. So if it's not going to bring any economic benefit, then it does not meet the definition of an asset. So for it to be an intangible asset, it must be capable of bringing economic benefits. It must be capable of bringing economic benefits. Then let's talk about goodwill. You mentioned goodwill. So goodwill, remember, as goodwill, that's the price we pay above the fair value of the business. So when you're acquiring another business, they can normally charge you a price above the value of the assets. They charge you a price above the fair value of the assets. So that price which you have paid, which is above the fair value of the assets, that is goodwill. So it is the price paid above the fair value of the assets. The price which we have paid above the fair value of the assets. So the assets of the business, if we add up the net assets of the business, so all the net assets of the business, they are maybe, let's say, all the net assets are of 45,000. But they say, okay, if you want our business, you need to pay 60,000. So that price above the net assets. So that price which we have paid above the net assets, that's the goodwill. So we are charged a price. Let's say they charge us, the purchase consideration is 60,000. Remember, in consolidation, then it means we have a goodwill of 15,000. So this goodwill, which has been generated, this goodwill is purchased goodwill. We have acquired this goodwill. So the goodwill can either be purchased goodwill or it can be internally generated. So goodwill can be purchased goodwill or internally generated. So we can have purchased goodwill or internally generated goodwill. So the rule is if the goodwill is purchased, we recognize it as a non-current asset. So purchased goodwill. Remember the goodwill, we are charging you because we have created the good name. We are charging you because we already have a customer base. We are charging you because you are buying an established business. So that price we paid because we bought an established business, we can recognize it as part of the benefits we bought. We can recognize it as an intangible asset we bought. But however, this intangible asset has to be tested for impairment. We have to be testing it for impairment annually because we can buy a business with a good name, but that can suddenly change because you have bought the business. So we talk about in terms of how we account for it, but purchased goodwill must be recorded. as an intangible non-current asset. An intangible non-current asset. So it's recorded as an intangible non-current asset. Then besides the purchased goodwill, we have inherent goodwill. Inherent goodwill. Which one is this one? This is internally generated goodwill. So this is internally generated. So you have created the name. Yes, we agree. It's you that has created the name, and you have created a very good name. But you can't start recognizing the goodwill in your books. You are the one that has created the good name. You are the one that has created the good image. You can't recognize the goodwill in your books. You can recognize the goodwill you bought from someone else, but you can't recognize internally generated goodwill. You can't start recognizing the goodwill that you have created in your assets. How do you tell it's a fair amount? Because you can end up just overstating. You tell yourself, I'm doing very well. People love my business, so I'm just going to give myself a goodwill of 100,000. What basis? So if it's purchased goodwill, it means someone has been willing to pay for that goodwill. They have been willing to value that goodwill at the price you have charged them, and they accepted and paid for that. But you can't say, I have created a good name, so I need to put this in my assets. So internally generated goodwill is not recognized. Internally generated goodwill is not recognized as a non-current asset. So this one should not be recognized as a non-current asset in the books. You will the one that we have bought together with the business, that's what we recognize in terms of goodwill. Then recognition of the intangible non-current asset. So recognition in the books. So when you're recognizing the intangible non-current asset, you can either use the cost model or the revaluation model. But initially, you recognize the intangible non-current asset at cost. Initially, the intangible non-current asset. Sorry, the intangible, that's right, intangible non-current assets is recorded at cost, recognized at cost. If the cost can be measured reliably. If the cost can be measured reliably. We'll talk about the measurement measured reliably. So we need to be able to determine what was the cost of this intangible non-current asset. If it was a license, what did you pay to be given this license? If it was a license, what did you pay to receive this license? Are you able to measure the cost with certainty? So if we can be able to tell the cost, then that's what we use for initial measurement. Then subsequently, meaning for the other years, Initially, we have recorded, but for the other years, subsequently, either the cost model or the revaluation model can be used. Subsequently, we can use either the cost model or the revaluation model. So initially, we have recorded it cost, but for the other coming years, we can adopt the cost model or a revaluation model. Let's start with the cost model, which is more appropriate though. So let's start with the cost model. So if we are using the cost model, we record at cost less amortization. So the intangible non-current asset, the intangible asset is recorded at cost less amortization charges. It's recorded at cost less amortization charges. What is amortization? Amortization is equivalent to depreciation of fixed assets, of tangible non-current assets. So the tangible non-current assets, they lose or we allocate depreciation over their useful life. But for intangible non-current assets, we amortize them. So amortization is equivalent to the depreciation, but for intangible non-current assets. So initially, we can get a license. For example, the company was given a license by ABC Limited to produce its products. For 10 years. The cost of the license was 8,000. So given something like this, it means given something like this, it means in terms of recording in our books, we initially recognize the cost 8,000. Then we account for the amortization charge. So the amortization charge will be the 8,000 divided by the period is for 10 years. So at the end of the period, it means we are going to have a carrying amount of 7.2. So our carrying amount of 7.2 is equivalent to, so that's our carrying amount there. That's the carrying amount at the end of the year. So our amortization is what is equivalent to depreciation. We spread it over the period of the license. So 8,000, we spread the 8,000 over a period of 10 years. Then we get our 8,000 or 800. Then let's move on. We have the other model where we can use a revaluation. This cost model is more ideal, but if the intangible non-current asset, has an indefinite, if it has an indefinite life, having an indefinite life, we are saying we don't know for how long we are going to be getting these benefits. So they can say, okay, you are going to use our license up to whenever you want. So we might maybe after 50 years and say, no, we no longer want to use this method. There are now better methods. So we don't know for how long. So if there is an indefinite life involved, we don't amortize the intangible asset, but we are supposed to test it for impairment annually. So intangible non-current assets, if the intangible non-current asset has an indefinite life, it is not amortized, but tested for impairment. We test it for impairment annually. So remember we did IAS36 impairment loss. We review for impairment annually. We check, is the carrying amount equal to the fair value? Is the carrying amount equal to the fair value? Then we have the revaluation model. The revaluation model. If we are using the revaluation model, it means at the end of the period, we revalue our intangible non-current assets. And if we revalue them, the gain is not, so the intangible non-current asset is revalued to fair value. And the gain taken to OCR. However, there are conditions that must be there. So it's not just a matter of you calculating using the revaluation model. This model is not advisable to use. So why? In most cases, there are no active markets for intangible non-current assets. So for intangible non-current assets, for us to be able to use this model, the revaluation model, there must be an active market for the intangible non-current asset. There must be an active market. So there must be an active market. For the non-current asset, there must be an active market. And a market price. And a market price for identical assets. There must be an active market for the intangible non-current asset, and besides there being an active market, there must also be a market price. There must be a market price. So what do we mean by this statement? It means if we are to go into the market right now, we should be able to find other firms that are selling similar licenses. So there must be similar licenses somewhere else, or there must be similar brand names being sold somewhere else. So an active market, it means the buying and selling of these intangible non-current assets must be taking place so that we can be able to determine, so in the market right now, how much is it going? Because for you to determine the fair value, you need to know what is the price in the market right now. But you rarely find an active market for intangible non-current assets. So most of, let's put this one as an NB point. Most intangible non-current assets, most intangible non-current assets, most intangible non-current assets do not have an active market. Most intangible non-current assets do not have an active market. Therefore, this model is not applicable. Therefore, this model is not applicable. We can't apply this one because for most intangible non-current assets, we don't have an active market. So let's have examples of other. So we've said goodwill is inherent goodwill is an internally generated non-current asset. I think we can also add on. So we can say examples of internally, this can come as a multiple choice question. So you need to know these ones are not capitalized, they're internally generated. Examples of internally generated tangible assets. You can have customer list. We can have training costs. These ones, you don't capitalize them. Inherent goodwill. So let's move on. So we want to talk about another special type of intangible assets, the development cost. So research and development. Research and development costs. So research and development costs. So research and development costs. So these are two areas that they have different accounting treatment, but they normally work together. You research and develop. But the treatment for research costs is different from the treatment for development costs. So the research costs, let's start with research costs. What are these? So the research costs, these are costs incurred in undertaking a planned investigation with the aim of gaining scientific knowledge and understanding. So take note, costs incurred in undertaking a planned investigation. So we are investigating something. It's a planned investigation. We are undertaking an investigation. It could be we want to find the method to cure a certain problem that we are facing. If it's research costs, it must be an investigation to either come up with a method, to come up with a product. So we are conducting an investigation. So research is meant to gain scientific knowledge. So you want to know more about how we can solve this problem. So we start by researching, we go into the field, we research. So we research. After we have researched, the next thing is to apply those research findings. To either create a method, we apply the research findings to either create a formula. So now the process of applying the research findings, the process of now applying your research findings, that is now development. So the development costs, these are costs of applying, take note of applying the research findings. We are applying the research findings or other knowledge to a plan, or we can say to a design for the production of a new product or service. So if it is development, it's now applying the research findings. Development is applying the results of research. Development is applying the results of research. So what is the big deal? Research costs, those costs you incur going into the field, finding out, conducting your research. Research costs are treated as expenses. These are expensed. So these are treated as expenses. So research costs are treated as expenses. So that's an easy treatment. Just go to expenses, you include your research costs. But the development costs now, development costs. With the development cost, there is a bit of an issue. Development costs. These are the costs of now applying your research findings. Development costs are capitalized. By capitalized, I mean we include them as intangible non-current assets. Development costs are capitalized. That's recording them as intangible non-current assets. So we capitalize them if they meet, or we can say upon meeting, from the day they meet the capitalization criteria, upon meeting the capitalization criteria. So we capitalize them upon meeting the capitalization criteria. What if they don't? Can add on and say otherwise they're expensed. So if they fail to meet the capitalization criteria, let's expense them. So otherwise, they are expense. So we're saying if they are failing to meet the capitalization criteria. So development costs, it means they have two treatments. They can either be treated as an expense or as an intangible non-current assets. Remember, where you put your goodwill, where you put your investments, you put your development costs. So the development cost, what gives rise to their capitalization? So the capitalization criteria for development costs. What criteria they must first of all meet for us to capitalize them? So let's look at the capitalization criteria for development costs. So we can use Pirate to memorize the criteria. So P, we are saying, for us to capitalize the development cost, there must be probable economic benefits. Probable economic benefits. That will flow to the entity. So we must be expecting probable economic benefits. We must be expecting that if we develop this, there is a possibility we will receive economic benefits. We must be expecting economic benefits from the development. So probable economic benefits. Besides the probable economic benefits, we have I. I, that's intention to complete. We must have an intention to complete the development. So if we start the development and we feel like the organization does not have sufficient resources to continue, or if there are any maybe issues that are causing the organization to stop with continuing with the development, it means from that date we treat those as expenses. So we must have an intention to finish up the development. We capitalize the development cost provided we intend to finish the development. If we have no intention to finish the development, then let's expense the development. So we are capitalizing the development cost because we have an intention to complete the development. Let's move on. Besides having an intention to complete, we also capitalize the development cost because so another condition is that there must be a reliable measure of the development cost incurred. We should be able to tell so far how much of the costs have we incurred. So if we can't tell how much are the development costs we have incurred, can't capitalize the cost that we don't do. So we must have a reliable measure, not a guesswork. There must be a reliable measure of how much of the development costs have we incurred. So there must be a reliable measure of the development costs. Besides the reliable measure, then we must have the resources. Let's have adequate resources. So before you capitalize, you have to measure against this scale and see whether all these conditions are there. Okay, you are developing, you are engaging in the development, but do you have the resources needed? If you do, you have all of them. So are the resources adequate? Are they enough to help you finish the development? So adequate resources to complete the development. Not to start, but to complete. Do you have adequate resources to complete the development? Then the next one is the technical feasibility. Technical feasibility. After we have completed the development, is it something that is capable of being used? So, okay, yes, we are developing this method, but is it something that is capable of being used to give us the solutions that we need? So the technical feasibility, is it feasible? Is the development feasible? Then lastly, expectation to be profitable. If we think it's a loss, then it becomes an onerous situation. We recognize it as an expense. Expectation to be profitable. So this goes along with the first one. Expectation to be profitable. So the first one was saying we're expecting economic benefits. So we are expecting it to be a profitable. We are expecting it to be a profitable development. So once any of these conditions are no longer met, if the conditions are not met, or even if we initially, the conditions were being met, but now they're no longer being met. Once these conditions are not being met, we stop recognizing the development cost as a non-current asset and recognize it as an expense. If the above conditions are no longer present. If the above conditions are no longer present, we de-recognize. We de-recognize the development cost as intangible asset and expense it. So we de-recognize it from intangible assets and recognize it under expenses. Okay, so this is not a new standard for you. So I'll just introduce a new standard, then we will proceed with this standard in the next session. So IFRS 5, non-current assets held for sale and discontinued operations. Assets held for sale. And discontinued. Assets held for sale and discontinued. Operations. So the assets held for sale and discontinued operations. So a non-current asset, when do we classify it as being held for sale? A non-current asset is classified as being held for sale. A non-current asset is classified as being held for sale if its carrying amount will be recovered principally through itself rather than use. So a non-current asset that we classify as being held for sale, we are saying we are likely to benefit from selling this non-current asset rather than to keep using. There are conditions that are showing that we are planning to sell this non-current asset. So it's highly probable that we are going to sell this non-current asset. Of course, we have not sold it, but conditions are showing that we are going to sell the asset. We look at which conditions in particular. For example, let's actually have the conditions for a non-current asset to be classified as held for sale. Conditions for a non-current asset to be classified as held for sale. So for us to classify a non-current asset as being held for sale, what conditions must be present? For us to classify the non-current asset as being held for sale, the first condition is we must be planning to sell this asset in a period of less than a year. So we're saying in less than a year, in less than 12 months, the sale should have taken place. Yes, we have this asset, you're using it in the business, but we're expecting that in a period of less than a year, we will have disposed of this asset. So the sale is likely to take place in less than a year. That's held for sale. The sale is likely to take place in less than a year. Then also, so in less than a year, we are saying we are planning in the next 12 months, the next 3 months, 6 months, 4 months, or even now, if you get a buyer, you can sell it. Then the asset must be ready for sale, meaning that it must be available for sale in its present condition. It can't be an asset that we are still using. You can't classify it as held for sale while the asset is still being used by the company. So the asset must be available for sale in its present condition. The asset must be available for sale. If we decide to sell it today, in its current condition, can we sell it? Or if we have to move people from that building, they're still using it, we are waiting to find another building, then it's not held for sale. It must be available for sale in its current conditions. Then management must be actively looking for a buyer. So management must be committed to a plan to sell the asset. They must have serious intent. They must have discussed about it in the board meetings. And they should have agreed, we are going to sell this asset. So that is showing the intent of the management. They are willing to dispose of this asset. They agreed to dispose of this asset. So we need to see the management's intent. Then, besides the management's intent, there must be an active plan to locate the buyer. So, active program. We must have a program in place, active program to locate the buyer. There must be something we're doing to locate the right candidate. We might have engaged an agent, or we could have put it in the newspaper, we could have advertised it somewhere. There should be a plan showing that we want to dispose of this asset. And lastly, maybe we can talk about the price. The asset must be marketed at a reasonable price. So the asset must be marketed at a reasonable price. That's another condition that must be present. So we should be marketing this at a reasonable price. So the price that we are charging can determine the intent, because we can't charge it a price which is way above the market price. It shows as if we are not willing to dispose of the asset. It doesn't show our serious intent. So it must be a reasonable price. Okay, so for today, I want you to go and digest this. So we'll start from there. I'll find questions, then I'll send. Then you can do as homework on these areas we have looked at. So maybe before we close, do we have any questions?